purchase a car, and a car generally has a 5-year write-off period. So you'd have to write off that expense over 5 years. The way the law is written now is you can accelerate that depreciation. So you can take all of that deduction in the first year, depending on what type of vehicle you get. So for example, if you have a luxury passenger car, there's a limitation on that. If you have an SUV, there's a limitation on that. But if it's a heavy-duty, truck or a pickup, dump truck or something like that, like a large industrial-sized vehicle, then you can take the entire deduction in the first year. There are a couple different ways that you can do that. The purchase, you can purchase it outright with cash. You can finance it and still take that deduction up front. You can lease it, and you can deduct a portion of the lease payments, depending on how much you use that vehicle for personal and business use. Or you can do something called a capital lease, where you have an option to buy the vehicle at a significantly reduced price at the end, where you can still treat that as though you're financing it. It's one of those things you really need to get with your CPA when you're making that purchase decision, and figure out what kind of vehicle you need to purchase, how you're going to finance it or lease it, or what the best options are, and discuss that whole process with them so you don't fall into any of the pitfalls that you may when purchasing a business vehicle. So the rules on like-kind exchange vehicles changed in 2018 with the Tax Cut and Job Act. Initially, what would happen is you would go to trade in a vehicle, and if you got a like vehicle, you would have a like-kind exchange. So you would have a vehicle that maybe you had written off in the first year, and you would go in and trade that vehicle in, and rather than having that gain or loss on your taxes in that year, the value of the old vehicle would basically be wrapped into the value of the new vehicle, and you would be able to defer that gain until you sold the new vehicle. In some cases the change is negative. So for example, if you've depreciated the entire vehicle in the first year, and then you go and trade it in now, because of the rule change, you can't treat that as a like-kind exchange anymore. You can't defer that gain. And so you would have depreciation recapture on that vehicle that you trade in, and the value that you get for that trade-in, if you've depreciated it 100%, would then become a taxable gain to you in that year. On the flip side, if you haven't accelerated the depreciation and you trade the vehicle in and it's not fully depreciated, you'd be able to take the loss in the current year. But the like-kind exchanges are now pretty much limited to real property, and so vehicles don't qualify. Yeah, there's some things to consider. The big thing to consider when you're selling or trading in a vehicle is how much depreciation that you've taken on it already. So if you have a $50,000 utility truck and you take all of the depreciation in the first year, and then you sell it within the first 5 years, you're going to have depreciation recapture on that sale. So the vehicle may be worth $50,000 and you might sell it for $10,000, but if you've taken all of the depreciation already, you're going to recapture $10,000 in depreciation. If you have the vehicle for more than 5 years, again, a utility truck, you've bought it for $50,000, you've depreciated it, but on the entire depreciation schedule, you don't have any depreciation recapture, but the vehicle's fully depreciated, so for tax purposes it's worth zero. So even though you may be able to go out and sell it, have a market value of $30,000, so you get $30,000 when you sell it, that entire amount's going to be taxable because you already took the deduction on the $50,000 vehicle when you first bought it. So at that point there's no basis left in the vehicle to deduct. Let's say you buy a $50,000 utility truck, you put it on a normal depreciation schedule, you don't like it, and you sell it after the first year. So you've depreciated it a little bit, you still have a lot of basis and value left for tax purposes in the vehicle. So the vehicle might, for tax purposes, still be worth $30,000 on your books. You sell it for $30,000, there's no gain or loss. It really depends on how much depreciation you've taken on the vehicle and what it was originally purchased for, much less than what it's actually worth when you sell it. You could have a car that's worth $10,000 and you sell it for $5,000, but if it's fully depreciated, you aren't taking a loss because the vehicle for tax purposes is worth zero. The tax basis of the vehicle is going to be what you've paid for it minus what you've depreciated off of the value of that vehicle. The depreciation schedule for a vehicle is normally 5 years. So if you buy the vehicle and you've only owned it for 2 years and you haven't taken any sort of accelerated depreciation, then you're still going to have 3 years worth of value left on that vehicle. That's completely regardless of what the Kelley Blue Book value might be. So if you purchase a vehicle and it's something that, like a Honda, that keeps its value very well, and so after 5 years, that car may still be very valuable on the market. You may be able to take that car out and get half of what you bought it for, just because it's kept its value. Maybe you didn't even drive it more than a little bit, and you only have 50,000 miles on it. It could be a very valuable vehicle in the market. However, if you've depreciated that vehicle all the way for tax purposes, it's not worth anything. So when you go to sell that vehicle, then you're going to be paying a gain on whatever you sell it for in your business, because there's no taxable basis or value to deduct against that. And you can add value to a vehicle, or you can extend the life of a vehicle if you make a major improvement. Let's say you have a car and you've kept it for 5 years and you fully depreciated it, and then you completely replace the engine and transmission. Those costs you can then capitalize, and that adds value back to that vehicle that's going to again be depreciated over time.